Okay. So hello, welcome everyone. We're just getting started. We're back. Welcome back to the CDW Investment Group's webinar tackling executive pay. The executive pay dilemma, part 2. We had a very lively discussion yesterday. The panelists are already warmed up. They're already in the gates. We're just ready to start. So we'll just let a couple people come in. So, hello everyone, welcome. We're just going to give people 1 or 2 minutes to come in before we start our webinar again. Welcome, you're at the CDW Investor Forum that's tackling the hot topic, executive pay. We're at the part 2 today. Thank you so much. We'll also have recordings available. We'll send you an email later on about that if you want to replay some of your favorite moments from yesterday or later today. I'm sure there will be some of them. And you'll see on the screen our esteemed panelists and a group of experts who have many years and some of them decades of experience with the work. So we appreciate that they joined us. So with no further ado, I'm turning it over to Rosanna Landis-Weaver, who is our moderator and the program manager at SUSO. Rosanna,
thanks everybody.
Take it away.
Well, let's start actually. We're going to have Nathan and Tal begin with a short presentation answering some of the questions that came up and clarifying some things from yesterday. So let's start with that.
Thanks, Rosanna. It's Nathan here. Since the audience is largely composed of people who attended yesterday, I'm not going to go through a formal introduction of CGlytics again. I'll spare you that so that we can have more time for the discussion onwards. Suffice it to say, we collect governance data around executive compensation, board composition, etc. And delighted to introduce Tao, who's a research analyst in our team. And we presented yesterday, you may recall, some information on executive trends in North America over the past few years. Tao has been working today to provide some updated information based on some of the requests we had from audience members yesterday. So with that, Tao, I'll hand over to you.
Yeah, thank you. I hope everyone can see the screen. Yesterday I was talking about some trends that I've seen in executive compensation. And I saw that there was a lot of interest in the pay for performance section. And so today I will mostly focus about pay for performance. So yesterday I showed this graph to you, which show the alignment of pay for performance with regards to total granted compensation. And as you know, the bars are showing the percentage of Russell 3000 companies falling into each category of misaligned, meaning overpaying, aligned, and conservative, meaning overpaying. And we found that 39% of the Russell 3000 companies overpaid their CEO. And that number is 778 companies to be exact. So I thought it would be interesting to take a closer look at the companies which misaligned pay practice. And to remind you again, misaligned here equals overpaying. And this graph here, you can see that the percentage of companies overpaying their CEO versus the total number of companies in their respective sector, and all of them in the Russell 3000. And we can see that the communication services sectors really stand out, with over half of the companies overpaying their CEO compared to their peers in the same index. And so even though compared to another sector, the financial sector, which has 146 companies overpaying their CEO, the number of communication service which overpay their CEO might be very small, only 58. But within the sector itself, the number comprises more than half of the industry. And the similar things happen in the energy sector. But in contrast, the financial companies represent the second highest number of overpaying companies, 146, But actually that number is only comprised about 1/5 of the sector representation on the index, meaning that only 1/5 of the financial companies on this index overpay their industry peers, which is the lowest portion compared to other sectors. And within the Russell 3000 index, financial companies are the least likely to overpay their chief, you can say that. And the story is a little different within the S&P 500. We found out that the 26 energy companies in the S&P 500, 88% of them are paying their CEO a bit too high compared to the company's performance. And that raises the questions of what is the industry standard in terms of pay for this sector and also for the other sectors in general, and whether this high percentage of overpaid CEOs happen due to groupthink. Within the whole index, the pay misalignment of energy companies may be less noticeable, but within the sector itself, it is the opposite. And I wonder why these CEOs are being paid better than their performance. And the similar stories also happen with communication services again. And even though these two sectors make up the small portion of the index, nearly 3/4 of the companies are overpaying their CEO. And so yesterday, as per Michael's request, we pulled some data which compares the performance of the lowest paying 10% of the S&P 500 to the highest paying 10% over 5 years. And you can see the red bars here show the average total granted compensation, and while the black bars show the average total granted compensation of the bottom 10%. And the red line show the average TSR of the top 10%, and the black line shows the TSR of the bottom 10%. And we found that there's a rather big discrepancy between the average pay of the top 10 versus the bottom 10, especially in 2017. The top 10% CEO got paid on average 11 times higher than the bottom 10%. However, you can see there's not much difference between the TSR performance between these two groups. And in fact, in 3 out of the 5 years, the bottom group actually outperformed the top 10%, albeit by not much. And this raises the question of whether this top 10% CEOs really deserve such a higher pay. Interestingly, however, that the picture is quite different when it comes to realized pay. On a realized compensation basis, we found an even bigger gap in compensation between the two groups. The CEOs of the top 10% take home much more than their peers in the bottom 10%, and usually about 25 times higher to be exact. But when it comes to realized pay for performance, it seems like the top 10% does perform better than the bottom 10, outperforming about 4 out of 5 years, 2015, 17, 18, and 19, by an average of about 7% overall. And I know that there are many opinions saying that realized pay provide more valid comparisons for performance than granted pay, which includes amounts that perhaps executive may never receive. So I think maybe this could open a discussion between the panelists over which type of pay is a better vehicle to measure pay for performance. And yeah, I will leave it at that, and I will answer any questions if anyone has any questions.
Great, thank you so much. And I really appreciate that. It's a very important distinction, and for folks who aren't as deep in the weeds, there's quite a big difference between what appears in the summary compensation table and what realized pay is. And in a bull market, it's been underestimated a lot. But the summary compensation table is what shareholders are able to vote on. So that is, sort of the direction with that. Thought yesterday's discussion was fantastic. Before I kick off today, there's one other thing I wanted to make a point of. There were so many good questions that came in. We're going to try to get some of those today, and also people should continue to ask more questions. But someone yesterday asked or noticed what they thought was a lack of indignation. And I just sort of want to go on the record and say that I do have indignation and even outrage. I think all of us share that to some level or another. We moderate that in terms of how we talk in different settings. But when this issue is new to you, it's really outrage is a really normal feeling to have, I think. So let's start off the conversation with sort of broader issues instead of the technical issues. And there's a whole bunch of questions in here together. Has the rise in executive compensation, or how has the rise in executive compensation contributed to income inequality? Are companies focusing too much on executive management at the expense of workers? What do you think about Leo Strine's proposal to give comp committees responsibility to oversee gain sharing among all workers, executives, and shareholders? And further, what is the appropriate role of the compensation committee in these matters? And this might also be a time where we touch on COVID. So there's a whole lot there. Adam, would you like to start us off?
Sure. Can you hear me now?
Mhm.
Okay. This is the outrage section, right?
Show us how you feel.
Yeah. And I don't think we're going to get that much into COVID, but let me just say briefly about that, because obviously that's sort of the context that we're all living within, and we're all thinking about day to day. I actually think that this past year is a golden opportunity for comp committees to be judging the CEO and how the CEO performed in a crisis. This, you don't get a crisis every year to judge, but when you get one, that's the real test of leadership. And I think it would be appropriate to compensate CEOs for handling that crisis well, because those are the kinds of leaders that we need. Those are the kinds of leaders that we want running our companies. What I don't want to see, and what I have been sort of hearing inklings of, is, well, this was an unprecedented crisis, and it's going to be really difficult for the CEO to hit their targets going forward, so let's make it easier. That's the wrong approach. You want leadership tested by these kinds of crises, and you want to have good metrics for gauging how well they perform. Let me get to the Strine proposal. For folks that are not familiar with it, Leo Strine, who's the recently retired Chief Justice of the Delaware Supreme Court, co-authored an article that is really worth reading and rereading, I think, because it's got some excellent questions in there that investors should be asking comp committees. And the idea basically is that the comp committee has been really focused on the CEO and maybe the NEOs, but really the very, very top of the company. And what he's proposing is that the role of the comp committee should be broader. The comp committee should also oversee how the general workforce is compensated, not setting their pay, not setting their benefits, but understanding the company's philosophy about compensation of the general workforce. And that gives them an opportunity to sort of gauge, well, what's the gap here between the CEO and the typical worker? We do have this pay ratio disclosure that's been required for a number of years. I would love to be using it in my voting. It's very difficult to do that, unfortunately, but I think it's an ideal metric for the comp committee to be using to understand, to try to start to restore some balance here between how the CEO is compensated and how the rest of the workforce is compensated. Does rising CEO pay contribute to wealth and income inequality in our society? I think there's no question that it does. I would leave the answer to the economists to solve, but it's very clear, at least within each company, it certainly does. And I think investors ought to be concerned about that. when the CEO's compensation is essentially off on a private island and the rest of the company is over here, that creates problems. That distorts decision making. That builds mistrust within the company. These things need to be kind of brought back together. And so it may be that Strine's proposal is a way of starting to ratchet down the size of these pay packages if it's done well. You know, I mean, I think some companies already have some of this language in the charters of their compensation committee. I'd like to see it more broadly applied. I'm certainly going to be raising that with companies going forward. So let me just stop there and see what others have to say.
Sounds good.
So if I may jump in here again,
Please.
this is Simiso, and you know, our view really is that the board is ultimately responsible for capital allocation decisions. And that means investing in assets to grow the business organically. That means paying down debt. That means acquiring other companies, paying dividends, share repurchases, and so forth. But when I say investing in assets to grow the business organically, that also means human capital. And you know, CalPERS is a set of investment beliefs, and one of our investment beliefs says that you know, long-term value creation requires effective management of three forms of capital: physical, financial, and human. And a lot of the times we hear companies say that employees are their greatest asset. And so if human capital is a company's greatest asset, does it get the prominence it deserves on the agenda at every board meeting? And here again, I'm talking about human capital management and not just compensation. You know, does the board have the insight into the human capital management metrics, employee development and training, workforce demographics and diversity, turnover and related employee acquisition costs, worker safety, health, etc. So really, when you think about this from a broader perspective, you think that human capital management being explicitly on the agenda at every board meeting might address the broader issues that maybe Leo Strine is trying to get at. And the second part of it, just to leverage what Adam said around the CEO pay ratio, you know, internal pay equity is something which we think is really important. And you know, when you look at how companies set pay and they use external peer benchmarking, which is fine, what about internal benchmarking as well? What about internal pay equity? So that's something which, again, you have to look at. I mean, we don't use the CEO pay ratio because of the, you know, the degrees of freedom or the flexibility that is awarded to companies in terms of how they calculate that. So you can't really compare it across companies, you know, the way you'd like to. But on a company to company basis, I mean, that internal pay equity is really important because ultimately, you know, value creation does not just reside with the CEO, it's about everyone in the company and so forth. So that's how we think about it from a broader perspective, that really it's, it should be a core function of the entire board, is part of the capital allocation decision of the board. I'll stop there.
Thank you. Carol, do you have something you want to add to that?
Well, just one thing on the pay ratio. I was wondering if we were going to talk about that because, you know, to Simiso's point, it's very difficult to use it as a company to company, and certainly not, you know, industry to industry comparator. But I would have thought, and I'm not sure if this is what you meant, Simiso, that year over year at an individual company, because my understanding was, and I may be remembering wrong, if a company does have a lot of flexibility to choose, you know, the methodology for determining that pay ratio, but if they change it, then they have to be very explicit about, you know, what they're doing and why, and they shouldn't be doing that year over year. So it always seemed to me that it could be a very useful tool for investors in gauging that attention to internal pay equity as a human capital issue, as well as an executive pay issue. If by following it year over year at a company, obviously if the ratio is getting bigger, you know, for no apparent reason, then that's a concern that is certainly very legitimate for an investor to raise, I think, with the board. And, you know, back to that point, it all comes back to the board one way or another eventually. So that I just wanted to, you know, to note that about the pay ratio. It was kind of dismissed at one point, but I would still view it as potentially, at least over time, a tool that, you know, just again, another arrow in the quiver of how to evaluate what's going on.
You know, can I make just a quick comment about that? Because I think, Carol, I'm glad you raised that, when it first came up, I think it was dismissed by a lot of investors as well. That's cute. Nice thing to have. I'm not really going to use it, right? I want to make it clear that many of us, we're not using it, but not because we don't think it's important. I see it as really the only, it's the only ratio, it's the only metric that we actually have to gauge wealth inequality within the corporate world, right? I mean, there's economic measures that we could be looking at, but within the corporate world, this is it. You know, this is the metric we got. The problem is the lack of comparability. The problem is the flexibility that companies were given, and that there isn't necessarily an ideal ratio per industry, you know?
Absolutely.
And so it's difficult to use. But not because it's not critically important. It is critically important, and I think maybe maybe it's just that we need to get the board to use it. We need to understand how the compensation committee uses it, and that should be part of the CDNA. They should explain when they're setting the CEO's compensation. Well, you know, we took a look at the pay ratio, and we like to keep it within the following range for the following reasons, and that's why we structured the pay the way we did. You know, that would be really refreshing to see, wouldn't it?
That sounds like a big ask.
I know, it is a big ask, but,
Yeah.
but honestly, otherwise, they're putting this figure out and nobody's using it. They're not using it, we're not using it. You know?
Yeah, I think, just to, you know, not to belabor this topic, but I think it's a danger for investors to say, you know, well, we can't use it because there's a lack of comparability. As I say, I've always thought, and, you know, I could be wrong, that there isn't comparability company to company, but there is company year to year over year. Company. And I can tell you from personal experience in talking to directors, the first year, they were all extremely nervous. Every board wanted to know, what is this number? How did we get it? What's the reaction going to be? And then the fact that there was little reaction, that then takes it off the table. Right. And that can be a shame for a tool to be useful, as you say, for the reason that you say.
And, you know, Michael made an excellent point yesterday about how disclosure has led to higher packages because CEOs see what other CEOs are making and they want to see it go higher. Well, this is a number that I'm sure they're not proud of and they don't want to see get larger. And so I thought when it was adopted, hey, there's a shame factor here. Just the point of putting the number out in itself, whether or not anybody uses it, is going to work. But it doesn't work if people ignore it.
Yeah.
It really doesn't.
Exactly.
You know.
Yeah, I think my point there, and I agree with everything that Adam has said, because exactly in terms of you can't use it as a voting number, but you can use it when you're engaging with the company from a company specific and trend analysis. Carol, you mentioned this year over year. You can look at, you know, any changes in that number and understand why is it changing, and that's how you can use it. But as a number which you can use just for voting purposes, I think it can be misleading.
And I just want to point out one of the reasons it's so hard to compare is that was very much a request from companies. They wanted to have a lot of leeway. There were shareholders that argued very strongly for a useful comparable figure, and companies resisted that and fought with a nail against this whole thing. So
Roseanne, I don't know if you want to move on to the next question, but since COVID came up and we were going to briefly say it, I just want to make a small point, which is I'm sure folks probably saw coverage in the New York Times and in the Financial Times about option grants, some special option grants that were awarded at the bottom of the market this year, back in March when stock price was at its lowest. Some special grants were made, and that's a huge concern. So we're talking about a lack of outrage on this panel. That's something to be outraged about, and I really feel that comp committees need to be held accountable for those decisions. You're on the board for your judgment and your wisdom. If you made this decision, I'd like to hear the explanation. I'm not going to say this like across the board, but this is the kind of thing that I think disqualifies you for being on a corporate board, these kinds of decisions. Now, I'd like to hear an explanation for it, and I think investors need to be demanding explanations for those kinds of payouts. But it's just, that's something that I think is just outrageous.
Yeah, I mean, I would say really, honestly, there's no good explanation for it. That speaks to the indignation. There's really not, and I'm not saying that as a joke. And I hate to sound like a broken record, but again, it's this same mantra, it's this same mindset that the overemphasis on performance and performance equity and pay for performance at the expense of pay quantum. So what they say in the explanation, which is boilerplate and kind of meaningless anyway, as well, if the executive can drive the stock price up, like the executive is about to get in their Bentley and literally take the share price in the passenger seat and drive it up. That's not what occurs. The Federal Reserve comes in and buoys assets. They can, if the company has a certain credit rating, if they can achieve a AA or AAA credit rating, the Federal Reserve and the Treasury are going to come in and buoy that company anyway. It's not going anywhere. The stock price is eventually going to go back up. So the performance element of it is a bit of a myth. Just a very brief story. Companies don't companies don't want to live and die by their stock price, and that's why we had this kind of performance myth. I was at one point when I was at ISS, we had an oil and gas company come in, and this is the gas prices were going down, oil prices were going down, and so the company said, well, listen, our CEO, he's doing everything that he's supposed to do, revenue, the cash flow, he's doing everything he's supposed to do. It's not his fault. So we got to find a way to incentivize him since it's not his fault. Well, I said in my mind, I didn't say this out loud of Lil Jr. at the time, so I couldn't really challenge the company the way I wanted to, but I wanted to say, okay, well, guess what? When oil prices were high and the stock price was high, did you say, well, it's not his fault that that oil prices went up and the stock price went up? Did you back out of that one? No, somehow when the stock price goes up, it's always attributed to the executives. And when the stock price is going down, it's never the executive's fault. And it's, we have to give him this special award to get because we know that he or she is the only one that can bring this stock price back up. When in reality, there are external effects that have nothing to do with that executive's talent. So there's no excuse. No explanation needed.
Right.
The process has gotten very long with all these rationales and disclosures.
All right. So you hardly need a moderator here. You could just keep going.
I was just going to say one thing, if I may. I'm not going to repeat everything that's said because it's really true. And that's actually how I was also thinking about it. But the question on outrage, we don't need vocal outrage. That outrage, let's see, it's in the votes. I mean, at the end of the day, companies and boards and CEOs understand the vote. And the first thing that they would say when we talk to them is, well, our plan got 90% support and things like that. So, the outrage, if there's any outrage, people should express that in their votes. That's my only point there.
Yeah, I think that's a good point. That's the only thing that's going to have any actual impact. Just one other word, as Samisa said, I don't think anybody would disagree with Michael's view of how it works. But I think it is a good point that in this year in particular, because of COVID, this is a global pandemic. This is not something that it certainly did affect some industries more than others, but bringing the stock price back has nothing to do at the end of the day, or little to do with an executive's specific actions, and much more to do with the course of the coronavirus. Not to disagree with Adam's earlier point that there are certain things that CEOs can do to ensure the viability of the company and the future success. But that goes back to, it all goes back to the board. And what is the compensation committee really thinking about? Are they just thinking, is it just a knee jerk? Oh my God, our stock price is down. It's not his fault. We got to do something to keep him, let's do some special grants. Or are they really thinking about what's going on? What is the CEO actually doing? What can the CEO do? And how should we be incentivizing and rewarding that?
Right. And I would also say how it's being done in the company. Go ahead, Michael.
I would just say, Carol, they're not really thinking, because CTW, we just launched a campaign. We just launched a campaign at Electronic Arts, and when I looked into it, they had one special award that was ongoing. They hadn't even completed the performance period for the special award that they had. It was like a 4-year performance period, and 3 years into it, they granted another special one-time award in the middle of a performance period for another special award on top of their ordinary equity. So, maybe, and I think boards are aware of what they're doing, so I don't know, maybe we can get them to think a little differently or get those folks off, but anyway.
Ask those questions.
So we had a lot of questions yesterday we didn't get to. We're going to try to get to some of them now that were a little bit more specific. One person asked, and I'm going to ask Simoso to take this one, what thoughts were about mega grants with very ambitious targets? So Tesla is an example they use, that the idea is the executive is being paid a lot, but shareholders are also rewarded. What is your take on those?
Yeah, I think for us, again, we tend to be against mega grants, and the idea in terms of the shareholder reward and whether shareholders get rewarded over the long term, we'll see with the stock price, obviously, and I won't talk specifically about Tesla because we don't talk specifically about any particular companies. But what we've observed sometimes is that some of the timing of these mega grants tends to be really, really so. These people are sort of perfect market timers, right? And they grant a mega grant, and then 6 weeks or a month, 6 months later, the stock price takes off, and you tend to wonder in terms of information arbitrage, right? We don't know, and we don't have insight in some of these things, but when we're using our pay for performance tool, for example, we notice these things because we can see that that dislocation, and then we see when exactly it started to happen, and we then go and drill down into that particular year, and then go into the proxy statements. And we've seen that with mega grants where you see this happening, and then a few months later, you see the stock price taking off, and you wonder, what people actually knew when and why that timing is so perfect. I think if the goals, sort of your performance goals that are stretchy, maybe it will work out, but to change from what you've historically done, because that's normally happens with companies, they have annual grants, and then all of a sudden they decide, no, this year we're going to do a mega grant and we won't do anything for the next 5 years. That should lead to questions from shareholders to say, what changed? If you historically, that's what we have done, and historically it has shown that, the performance has been there, maybe that's okay, but we tend to have a negative view. And that also is the reason why when we look at pay for performance, we just don't look at on a going forward basis. We actually look at historic performance and, just look at how you've performed in the past and versus what was granted in the past to just see whether that's actually justified.
Thank you. That's very helpful. I'm going to move right on to the next one so we can cover some more because we've had several more come in. And
Well, you're on mute. I think Carol was on.
Am I? Can you hear me?
Yeah.
Oh, okay. No, go ahead, Roseanne. I was going to say something, but get to the question.
You can wrap it into your answer on this one because I'm going to give this one to you anyway. This is someone made the point about executive compensation consultants as the very best lemonade makers. They can always find a way on any stat to ratchet up pay. And they mention here, as evidenced by some of the statements coming from consultants regarding pay during the pandemic.
Mm-hmm.
What tools do you think are most effective in slowing that ratcheting down or stopping that ratcheting?
The same tools that have been around for a little while. Going back to Samiso's point yesterday, Stay on Pay is that tool. It's not a solution, but it is a tool to get in front of the compensation committee, to get at the table and be asking those questions. There's no way to stop consultants. And, again, based on experience, I would say, what you have to be careful about. And I think, again, Samiso, you had a story yesterday recounting a time that you talked to the compensation committee, I think, and realized, oh, they don't really know what's going on. They could just talked about their excellent consultant that they had. And they probably believe that. But the fact of the matter is, as a practical matter, the rulemaking eliminated direct conflicts of interest for the board's consultant. The board now nominally hires its own consultant that doesn't do any work for management. But as a practical matter, consultants have to work with management because they have all the information. It's the same, sand trap that the board is in. They're hostage to the information that they get from management, basically. And the board's consultant is, in the same boat. The only information they have about the company is coming from management. And so that gives them, a built-in sort of bias to begin with. Secondarily, I think, again, even absent a direct conflict of interest, there is just a general, tendency by nature of consultants not to, defy management. They're looking for some sort of compromise between what management wants and what the board is ready and willing to go along with. So just because the consultant works for the board, I would say definitely doesn't necessarily mean they are totally objective and act and only trying to protect shareholders' interest. But that goes back to the tools. So what tools do we have? Well, the proxy isn't a great tool because, again, the information is sort of chopped up and it's still just one kind of perspective on what's going on. But talking to the compensation committee and getting that confidence that they know what they're doing and they have a good rationale for what it is, you can't stop benchmarking. I don't, at least the last time I looked at it, few, if any, companies were literally targeting pay above median. But as we know, just because of the trend in certain people getting more pay every year, the median tends to rise every year. That's just a mathematical fact. And so, but to get deeper into it means finding out, okay, who's in your peer group, to the point about Netflix and Schlumberger, which median are you looking at and why? How are you setting targets relative to that median? Are the targets challenging to hit, are the performance targets challenging enough to hit the pay target? Or are they, a relatively low bar to hit that pay target? Or are they too challenging? I think the slides that Tao had sort of demonstrated companies are doing it differently. And that's the kind of probing, that investors need to do. Unfortunately, not all investors obviously have the, the staff and the time and the money to do that. But that would be my tool. I'll just leave it at that.
I did want to make a point, and some people had sort of raised that sort of CalPERS is able to do things we can't sort of point yesterday as well.
Yeah.
And that is true, but I would also say between ISS and Glass Lewis, you can have a policy that you adjust to yourselves. And actually that's what CalPERS has largely done. Taking some very specific information and then letting it churn through. So even if you don't have the ability to engage at the level others may, you can still vote. Again, it's a non-binding proposal. You're just telling the company what you think. It should not. And I'm the moderator. Let me ask another question.
Can I
Sure.
can I just I just want to echo what Carol was saying, and I want to say that I know we talk a lot about comp consultants and comp consultants kind of being the bad guy. I think comp consultants got the ball rolling. I already mentioned that with Arc Patent at McKinsey in the 1960s, but now I think kind of the inmates have taken over the asylum. And I don't really think it's the compensation consultants anymore as much as and I worked at a couple of big corporations in their executive compensation department. And it's more so the executives themselves that get on the phone and call HR and say, hey, my equity is not vested. And then HR said, all right, cool. They call Towers Watson and say, listen, Towers Watson, this is why we brought you in. Figure out a way to explain this on our proxy and gussy up our proxy and find a way to convince ISS and Glass Lewis that what we're doing here with this special award, because the original one is investing, is okay, right? Try to give us, and so I think that it's not necessarily the comp consultants as it is the companies themselves these days. And when it comes to, what is going to stop that rationing effect, because I think that was the second part of that question, not to sound like a broken record, the problem is, I believe, and this gets to what you were saying, Rosanna, about Glass Lewis and ISS being able to have a policy that is effective at slowing down the ratcheting. I believe the problem is an overemphasis of performance equity at the expense of pay quantum. And the solution is to kind of reverse that and to be a little bit more lenient about, the composition of what's inside, especially the equity, what's inside and how much of it is performance-based, how much of it is time-based, and concentrate more so on the quantum. So it's okay if, it's all time vesting equity, full value time vesting equity, if the pay package is smaller. And right now, the standards for, Glass Lewis has their A, B, C, and ISS has their low, medium, high. Those standards, you can go up to 2.5 times the median, and you'll be I believe you'll be in a medium concern. So maybe they need to back off of, the qualitative aspects of the, how rigorous the goals are and all this stuff that has to do more so with the analysis of the equity, and be more lenient with that. It's 100% time-based equity. Okay, fine. And be more stringent on that quantitative component and the quantum of pay. That would be, and then if we can get asset managers and proxy advisors on the same page with that, that will have a significant effect on slowing the ratcheting effect.
Okay, thank you, Michael. That takes us through to the next one, which is, when we talk about these metrics, there's been a lot of push lately for including sustainability metrics, adding specific sustainability goals for like linking executive pay to carbon reduction goals, that sort of things. Wondering what companies are doing effectively. What should shareholders be doing? What do you think? And Adam, we talked about this before the call actually officially started. So I'm just going to send it right back to you, and you can repeat what you said to just the
Yeah, sure. Well, let me say first off that I support the idea, right? I mean, if a company tells you that sustainability is important and it's a core business objective, but they're not compensating their CEO based on those factors, it should raise. What am I? Okay, I thought I was on mute there. It should raise questions, and I think those are legitimate questions. What I think is though really important is make sure that you go through to the next phase, which is how is it structured? Not simply, hey, we included some ESG factors in our CEO comp plan. Great, everything's great, let's move on. Because I think in a lot of cases, the way I've been putting it, I don't know if this makes sense to everybody, it's just another ornament on the Christmas tree. You know, it's just yet another opportunity to grant the CEO more money, more equity, for meeting what are often not very clearly defined goals. And it's sort of, they're structured as like, well, the sustainability, you have all the core business objectives here, and then you have a small percentage focused on some sustainability goals. And even if they're clearly defined, they're still a very small piece. And it's a nice to have. It's not a core business objective. If it's a core business objective, then it ought to be one of the key, you know, one of the key metrics, and there ought to be negative consequences for failing to meet those goals. The other quick thing I will say, because I think in general, we need to have fewer overall metrics. I think some of these are just, there's way too many metrics. It's too complicated. I don't see how that motivates anybody when you've got, you know, 12 different things you got to look at. So you don't necessarily want to be adding sustainability metrics. I would maybe pull out one of the financial metrics and plug in a sustainability metric. But I don't want to contribute to increasing the complexity of these plans. So I think more work needs to be done to figure out how do we do this so that it's truly effective and that it is really driving better sustainability performance as core business objectives. And I think haven't quite gotten there yet.
All right, here's one of the questions that came in today. I wondered if any of the panel is aware of data on nations or companies where workers are on the boards, and whether that's where there's a noticeable difference in executive compensation trends or CEO pay ratios that might be attributable to that feature of board composition.
I think
Carol, you
as a requirement, I believe, if it's still in fact, for worker representation on boards. And I mean, you know, at the end of the day, the US is on its own planet when it comes to executive pay. So I'm not sure that you could point to, you know, to that making a big difference. And actually, I think that's, you know, maybe worth talking about, not that we have the time, but, you know, there's an element here that is just, US executive pay is kind of reflective of US society and American, you know, sort of values in general. And I think we've, dare I say it, I mean, we've seen, for instance, in the last year, a focus, and especially by certain leaders, on valuing, you know, individual rights, for example, over the collective good. Mm-hmm. When it comes to how to deal with the pandemic. And that I think, you know, it may sound crazy, but I think that is also one of the factors in the US executive pay system. There's just a lot of emphasis on this idea of individuality, of the, you know, the super CEO and so on. And, you know, being able to single-handedly, you know, make a company successful. That's just part of the American fabric that is probably more of a factor than whether there's work representation on the board.
Although it hasn't, you know, always
an interesting question.
Yeah, it hasn't always been part of the American fabric. So that is, but that is again a larger question.
Not to the extent that we, we have now. True.
All right, I'm going to go on to another one if no one else wants to add to that. Well, this gets to this thing. Probing and discussing executive pay seems like you're sort of letting them, I guess, the companies frame the conversation. What if you think drastic change is necessary? CEO pay should be halved. What revolutionary steps can shareholders take? Negotiating is going to take too long.
Good luck.
Adam?
Well, this is one of the problems. You know, we were talking about does Say on Pay work yesterday? And I don't know if we had a consensus on that. But one of my frustrations with Say on Pay is, and I support it, you know, and I do think, you know, I think Sumiso is right that shareholders have failed Say on Pay and not the other way around. but you only get to vote on what you're presented with.
Mhm.
And that is so frustrating, because you look at it sometimes and you see 25 things that you would like to change, or 25 things you're really upset about. Well, it's an up or down vote. There's not that much. Yes, of course you can get them on the phone, but not all of them, right? So it is frustrating, and I do feel like wholesale change needs to happen. I don't think that we're going to be able to tweak this and get it right. And Say on Pay doesn't really offer you the opportunity for that broad, sweeping change that I think we need. So I think we need to sort of go outside of the proxy process to have that conversation with boards. Carol was giving some examples yesterday about how regulation to date has not worked, and that in some cases it's actually made things dramatically worse. I guess I would say, her examples were exactly right. I think they were just the wrong regulations, though. I wouldn't necessarily say that regulation per se doesn't work in this area, because honestly, if you leave it up to boards to figure out, and the boards are made up of CEOs at other companies, and you leave it up to investors and boards to have this conversation forever, well, we know where that's gone. We know how that story ends. We need some other players at the table to sort of help sort this out.
Can I can I chime in there as well? Oh, sorry. Go ahead.
Go ahead, Michael. Go ahead.
Okay. Well, I would say there's two conversations going on. To directly answer the question, target middle and low performers. Those are the ones that, you can expect a 50%, 60% pay cut from middling companies that are just riding the wave of a bull market, and definitely low performers where the S&P is doing one thing or the Russell 3000 is doing one thing and their stock price is doing something else. S&P 500 going like this, their stock price going like that. You can target those companies. When it comes to high performers, that's a different conversation. That is a conversation of how much is too much, right? And we get into this philosophical conversation about, the people at Disney, they're paid too much. And that may be something to discuss. At the same time, if you are engaging in something, if you are consuming something that, you use every day, like Netflix, or, something that you really like Marvel's Avengers or what have you, you got to understand that, when a company innovates or invents something that is consumed by masses of people all the time, your Apples or whatever, they're gonna get paid. Okay, they're gonna make a lot of money. But I think the middle and low performers, that's where you target, and that is where you should be seeing a lot of change.
Thanks.
If I may jump in,
Sure.
can I?
Yes.
So the way I'm thinking about this is that really, I agree with what the previous panelists have said, but this is really broader. It's really broader than just Say on Pay. And to what I said yesterday, in terms of governance, the system of governance that we have in place maybe is not the best in terms of the things that we're trying to achieve. So really, this is something that has to go beyond that. I don't think regulation is the right way. It can aid the process, but we know that there have been unintended consequences from regulation. So there are three broad issues that I see which are problematic, and maybe if we focus on those, I don't know how to solve them, but here are the three things that I think about. So there's the free rider problem in public markets, right? Because of the dispersed shareholding, there's not enough investment in the governance oversight. So there's really no mechanism for accountability either of management or the board, right? And here we're talking about this and we're saying, well, can we have the pay and stuff like that? But the free rider problem is not going away. People saying, well, we don't have the resources to do this. Well, if you don't have the resources, then there won't be accountability. That's the first thing. The second thing is directors don't have, a lot of directors don't have or have little skin in the game, right? They really don't have any financial motivation to drive change. And as a result, they tend to be reactive as opposed to be proactive and cede power to the CEO. So the issue that I think it was Carol who raised in terms of, or maybe it was Michael who raised in terms of, the CEOs tend to end up being driving everything, whether they're talking about consultants or they're talking about the board. So the fact that the directors don't have enough skin in the game is a big issue. And maybe it's time to get investors to be on boards of these companies, the providers of capital. I don't know whether that's the right solution or not, but that to me is also problematic. And then the third point is this issue of information arbitrage between management and boards, investors and management, and investors and boards. And this really leaves a lot of gaps which can be easily exploited, and means that we end up not addressing these issues. And contrast that with the private markets, private equity, for example, where the owners of private equity companies are sitting on those boards. They're aligned. The people they put on the boards are targeted either for their business expertise, in terms of whether they were trying to get the company to go this way in terms of strategy and stuff like that. They have skin in the game. And really there are milestones, and they're also able to look at the information. There's no information arbitrage as far as private equity is concerned. So maybe there's a lesson there. There are things that we may learn from private equity in terms of how to align or solve this problem. But I don't know what the solution is, I think, but those are the three main challenges that I see out there. I'll stop there.
Okay.
Is there time for one more? Is that it?
Well, yeah, go
For a
ahead.
comment? Sorry.
Yeah, go ahead.
I was just going to say, because and I totally understand Adam's frustration and all the points raised, Michael and Simiso. But again, we just talked earlier about yet another example of regulation falling short on the pay ratio, and I've, after watching this for 4 decades, I just can't help but feel strongly that that is not an effective solution ever. And the risks are far outweigh the potential. On the other hand,
I'm with you.
to, again, one thing we haven't talked about, but should, or I assumed would ultimately be part of that, the solution along the lines that Simiso is talking about, is proxy access. And giving investors the ability to have more of a voice in potentially who's on the board. Now, obviously the proxy access, rules at companies, they're all, a little all over the map. It's not an easy process, but again, it goes back to the people that have skin in the game, the investors that, have a reason to, make their voices heard in the boardroom. Doing that either by getting directly on the board, as the private equity example, or certainly through, again, their votes and the long, hard slog of engagement. But forgive me, I guess I'm just jaded after so long, but I just don't think that there is a revolutionary solution that is actually going to happen and work. It's really more of that long slog of trying to, as Michael said, target the real abusers, target them even if it's one by one, and target the bad practices. I don't think we got to the severance question, but there's another one that's sort of right now for investors to really, make more of an issue of, well, what's the point of all this severance payment? Especially in certain instances when it doesn't seem to be warranted at all. But anyway, I'll stop now because I know we're running out of time. But hate to throw cold water, but it's
we need to end on a more upbeat note than that.
Yeah.
No, your cynicism is well earned, and we appreciate it. I remember you telling me once that it was like squeezing a balloon, like the air is just going to go somewhere else. It's just going to pop somewhere else. Although I do think we have seen some bad practices that really have evolved. I don't want to, and especially with pay, we've seen some very particular, some of the most egregious things just don't happen anymore. And it's easy to lose sight of that when pay continues to be exorbitant. But I think there have been some important changes over the course of time. There are so many questions, and I don't know if we have enough time for one more. Let's see, probably not. Is anything, I tell you what, I'm going to do one lightning round question here. What entities or organizations do you feel like have the most agency to really make change? There's easy to take that, and just a 30-second answer on that, and we'll call it a day then. Carol, do you want to start?
Well, the SEC, I would say, is the most powerful in a sense. They, however, they are very subject to corporate lobbying, and so typically what they do is something that's going to assuage in some way the corporations. Even when they attempt to do something that would benefit investors. So then you have obviously the CII and investor organizations that that can speak in some sort of collective voice on behalf of shareholders to encourage change. I'll pass it on.
Yeah, my answer is a short one. Investors. I'm not. And again, I go back to the issue of. If we're not happy, at least let's express that unhappiness with the tools that we have. And then maybe those organizations that have authority and power to do certain things can see that right now, when those organizations look at the votes, they don't see any issue. So I think we just need to vote.
Michael?
Yeah, I would say, without question, it's the institutional shareholders and the proxy advisors. I believe those are the two entities that are best positioned to make change. These large asset managers and institutional shareholders, if they don't want to see something, it's not there. It shall not happen when they have that much invested in that company. So they have a huge amount of sway. And as for the proxy advisors, they like to say that they're not trendsetters, but I do believe that they say, okay, we're just kind of taking investor feedback and then, synthesizing it and coming up. But in reality, I think they do a little bit of trend setting. And I do believe that a lot of companies cue in, they take their cues from what ISS is doing, to the point where if ISS recommends one way or Glass Lewis recommends one way, then they're gonna recommend that way without looking too much into it. It's not true in all cases, but I do think that the proxy advisors are more of a trendsetter than they'd like you to believe.
And Adam.
Tough question for a lightning round. I'm going to say that I've always said that investors are at least half the problem. And when I say the problem, it's pretty much any problem I can think of. So I have to go, and it's the only thing that I actually have any direct control over. So yeah, investors are probably the number one, although we need to come to some sort of agreement on what is the nature of the problem, as I said yesterday. Is it quantum? Is it a misalignment with performance? Is it something else? And I totally agree we need to vote accordingly, but I don't want to rule out the regulator. I really think that excessive, as we said before, excessive executive compensation is contributing to wealth inequality, which is a significant economic risk. And it is beholden on the government and the SEC in particular to do something about that. Now, whether they're going to do it in the right way remains to be seen, right? But I don't want to rule them out as a player here. I think they are a critical player, because I think if you leave it up to the private sector, we're looking at the fruits of our labor here. That's why we have a problem in the first place.
I could agree with you, Adam, but I think it's the Federal Reserve on that, not the SEC.
Oh, okay.
I feel like the Federal.
We'll bring in the Fed.
Well, there's the Fed, and there's taxation. There's all kinds of.
Get out of the market.
It's not just the SEC. I agree. It's not just the SEC.
But to your point, Rosanna, we shouldn't end on a down note. I mean, I think in many ways, you know, investors have had, and the proxy advisors have had an impact, absolutely, on company behavior. It hasn't, you know, moderated the rise in executive pay, but that also, I mean, let's face it, for the last 10 years, which is when it's grown the most, you know, the market has more or less been on a roll for, you know, whatever reason, with a few blips here and there. And so that, you know, that has contributed to that. But in many other ways, and certainly at individual companies, I think investors have had a significant impact on what goes on.
Thank you, Carol.
Yeah.
Dieter, did you have any concluding remarks you wanted to make?
Oh, sure. Thank you, Rosanna, for turning it over. And thank you, really, Rosanna, for again doing a superb job keeping the conversation going and really allowing everyone to chime in and pick good questions from the audience. We're very sorry that we couldn't get to all your questions, but as I said, we will post a recording of this conversation on our website, and we'll let you know where you can find it. So, and of course, please join me and thank all the panelists for their time and really good ideas and interventions. I enjoyed again, and so thank you very much, Carol, Adam, Michael, and Simiso. Thank you again. Bye bye.
Thank you.
And
Thank you for having us. Bye.
thank you,
Thank you.
attendees. Okay, bye bye.
Bye.
Thank you.
Bye.